Hi, this is CH. This video is part of a series of videos titled My ABCs or Absolutely Biased Comments to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Fidelity Global Multi-Asset Income Fund, or more commonly referred in the industry as Fidelity GMAI, pronounced as GMAI. This video is done as a follow-up request from a viewer's comment in my previous video covering the Amundi Index MSCI World Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. Fidelity comes with two distinct identities in the financial industry. The original US entity is known as Fidelity Investments. Founded in 1946 by Edward C. Johnson II, Fidelity Investments is one of the largest asset managers in the world, with 15 trillion US dollars of assets under administration. It provides a full range of investment services to US clients, from investment products to wealth planning to financial advisory to trading platform to discretionary solutions. The firm created an international investment subsidiary in 1969 to focus on businesses outside of US. By 1980, the international business reached enough scale, and Fidelity decided to spin it off as an independent entity called Fidelity International Limited, or FIL. Both Fidelity Investments and Fidelity International remain privately owned businesses. Abigail Johnson, granddaughter of the founder, is currently the chairwoman, president, and CEO of Fidelity Investments, as well as chairwoman of Fidelity International. The Johnson family and affiliates own around 40% interest in both entities, and the remaining 60% are owned by current and ex-executives of the firm. Fidelity International today manages over 900 billion US dollars of assets, with presence in over 25 locations globally. Mutual fund holdings are the core business, though Fidelity International also provides pension management and fund platforms in various countries. Fund offerings are categorized into multi-asset funds, bond funds, equity funds, and cash funds. Fidelity GMAI, which is covered in this video, falls under the multi-asset funds category. Fidelity GMAI is a sub-fund under the Fidelity Funds fund family. Fidelity Funds is set up as a Luxembourg SICAV company structure and its use is qualified. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The Fidelity GMAI webpage and fact sheet lists 3 co-managers for the fund. There is however no further bios available in the fund webpage, although searching for the names within the Fidelity websites gives some results. I wonder why Fidelity doesn't just provide the bio links in the fund webpage for convenience. Talib looks to be a recent hire in Q4 2023. He is best known in the industry for about 20 years in JP Morgan Asset Management, running similar global multi-asset income products, although he moved to Jupiter Asset Management for a while before joining Fidelity. I suppose he is hired to bring over best practices from his prior firms and to improve the multi-asset solutions in Fidelity. George looks to be the longest serving member in the multi-asset team among the 3. Having joined the firm and the team in 2011 as a research analyst, then over the years promoted eventually to a portfolio manager in 2017. His experience looks to be fixed income focused. Becky joined the firm and the team in 2014, also as a research analyst, and similarly over the years promoted eventually to a portfolio manager in 2022. Her experience looks to be fixed income manager research focused, meaning she does due diligence on internal and external bond funds. This also means Fidelity's multi-asset solutions will invest in other mutual funds from both internally as well as externally. Morningstar provides a bit more information on the history of the fund managers. It appears there were quite a number of manager changes since fund inception in 2013. George is the longest serving co-manager for the fund since 2016, while Talib and Becky only joined in managing the fund from 2024 onwards. It would be good if the team can stabilize for long term. Separately, given George and Becky appear to cover the fixed income asset class, while Talib is probably better focusing on the big picture and asset allocation strategy, it makes me wonder if there is a gap in terms of coverage for equity asset class. The Fidelity GMAI provides an investment objective and investment policy in its website and fact sheet. The objective states the fund aims to achieve moderate capital growth over medium to long term and provide income. There is no information on what is considered moderate capital growth and also no information on what is the expected income yield to be generated. The investment policy states the fund can invest in a wide variety of equity and bond asset classes globally. This follows with a long list of allocation constraints by asset and sub-asset classes, so let's take a look. It is stated that the fund can invest up to 100% in investment-grade bonds, but only up to 50% in equities. Money market instruments is up to 25%. From this, we can gather that the highest equity to bond ratio will only be 50-50. So this is slightly less aggressive than the usual 60 equities, 40 bonds allocation when it comes to multi-asset portfolios. If we take a proportion guess, the portfolio should be more like 33% equities and 66% bonds in normal circumstances. Money market allocation provides the flexibility for the fund to de-risk during market stress periods. This also provides an explanation why the co-manager mix has a tilt towards bond asset classes. There are quite a lot of constraints for the bonds part. Besides the 100% in investment-grade bonds, the fund can invest up to 50% in government bonds, meaning the rest has to be corporate bonds, but that's not too concerning. The fund can also invest up to 60% in high-yield bonds and up to 50% in emerging market bonds. These two constraints are more concerning as the fund will likely be taking on substantial credit risk if it chooses to scale towards these two limits. The fund can invest up to 20% in China onshore bonds, which I think should be a subset of emerging market bonds. The fund can also invest up to 20% in cocoa bonds and up to 30% in a mix of hybrids and cocoa bonds. I generally categorize cocoa bonds as similar risk as high-yield bonds, but it is not clear here whether Fidelity treats cocoa bonds as a subset or a different category to high-yield bonds. It is also mentioned that the fund can invest in other subordinated financial debt, which would normally be Tier 2 financial bonds, and there is no limit mentioned here. Lastly, the fund can also invest up to 10% in distressed securities, which I don't really like as I think distressed investing is best meant for hedge funds that focus on distressed opportunities. For equities, besides the max 50% overall allocation, the fund can invest up to 20% in China onshore A and B shares, which is an aggregate limit with China onshore bonds. There is no constraint on other geographic regions though. The fund can also invest up to 30% REITs and up to 30% infrastructure securities, but again, there is no constraint on specific sectors. There is also a max 5% in SPACs, which I don't really like as I feel SPACs are more opportunistic short-term bets that are not suitable in long-term fund investing. Lastly, the fund can also invest in preferred shares with no limits. There is a lot of information to absorb here, although let's continue to the fund prospectus to see what else is available. In the benchmarks section, the prospectus states there is no benchmark defined for Fidelity GMAI. I however think the rationale is weak, as all funds need to have some kind of target objective in order to assess whether the fund is doing good or bad. If an asset allocation based benchmark, for example a customized 40% equities, 60% bonds benchmark, expressed via MSCI World Index and Bloomberg Global Aggregate Bond Index, is not good enough for the fund could have also considered using a returns target or income target, for example SOFR plus X% as a benchmark. Without any benchmarks, an investor won't even know what he is expecting to get out of the fund. The prospectus also provides a short paragraph of investment process, where it states the fund manager will allocate investments across asset classes and geographic areas based on their potential to generate income and capital growth or reduce overall risk. This is basically saying we will do what we think is right and provides no details at all how the investment process works, which is quite unfortunate as I thought Fidelity would have done better in explaining what the fund is trying to do in the portfolio. The one good thing that the prospectus is clear to state that the fund's income is mainly generated by underlying equity dividends and bond coupons. So hopefully, we won't see the use of derivatives such as equity-linked notes or covered call options to generate income. There is a big chunk of investment process talking about factoring ESG considerations in the investment process. However, this doesn't help to explain the process itself, and there is no measurement how the ESG considerations attribute to overall funds returns. The prospectus also mentions the fund will use derivatives for investment purposes besides the usual hedging and efficient portfolio management purposes. It is expected for the fund to have around 80% total return swaps or TRS, although there is no elaboration what type of investments are involved. The fund is also expected to have around 15% securities lending, which is low and shouldn't be of concern. Finally, it is stated the base currency of the fund is US dollars. There is no mention about the ability for the fund to invest in other mutual funds, although it was indirectly mentioned in one of the co-managers, Becky's bios. That's actually all there is available in the fund documents to explain the fund, which is hardly useful at all. There is no information at all about whether this is a top-down macro-driven or bottom-up securities selection focus, or whether it relies on quantitative modeling or fundamental analysis by a team of research analysts, or anything else that at least gives investors some idea how the fund is run. This feels very much to me like a poorly marketed discretionary portfolio mandate from a bank that essentially says, this is what we will roughly invest in. Give us your money, don't worry about how we invest, trust us, and we'll deliver something. Not quite convincing, isn't it? Fidelity GMAI was launched in 2013, so that gives it slightly more than 10 years of track record. It currently has slightly over 4.2 billion US dollars of AUM, which is about the same as BlackRock's equivalent solution, but much smaller than JP Morgan Asset Management's equivalent solution. The portfolio has a massive number of holdings of over 2,700. The fund webpage strangely does not provide any information on the portfolio construct, so we will have to refer to the fact sheet for information. The fact sheet provides a high-level asset allocation and geographic breakdown of the full portfolio. The overall asset allocations look quite close to the 33% equity, 66% bond mix that I mentioned earlier. There seems to be quite a bit of derivatives used, which led to a negative cash position. But without any details, we don't really know what the fund has deployed in the portfolio. The geographic exposure shows something interesting. For a fund that is base currency in US dollars and with a global investment mandate, it has a very low US exposure of around 27%. On the flip side, it has a very high Asia ex-Japan exposure of around 26%. The 17% in other probably refers to emerging markets ex-Asia and is also a very high exposure. This translates to a total of around 45% in emerging markets including Asia. This is quite unconventional compared to peers and suggests the fund managers may have a view that EM and Asia have a better risk-return reward than developed markets, and therefore made a very deliberate and distinct allocation decision here. The fact sheet also provides further breakdown separately for equities and fixed income categories. The equities breakdown only provides for geography but no sector. So unfortunately, we don't know what kind of sector biases the fund has. It similarly shows a rather high weight in Asia, but there is minimal emerging markets in equities. The bonds breakdown provides a bit more details. Here, we can see about 21% each in investment grade and high yield, and they are mainly via Europe issues. There is also about 7% in Asia unrated bonds. Lastly, nearly all the portfolio's emerging market exposures are here, in a mix of EM hard currency and local currency debt. There is no information on sovereigns versus corporates though. There is also no credit rating and maturity breakdown, and we only know the average credit rating of the portfolio is BBB, and effective duration is currently 2.91 years. While the portfolio has over 2,700 holdings, and normally looking at top 10 holdings of such funds aren't too useful, the fact that there is a lack of details in the investment process makes it more meaningful for us to study the top 10 holdings for this fund. Here, we can see the top 10 holdings are dominated by various sovereign bonds from US Treasuries to various others from the rest of the world. There is also a US Treasury futures holding, which is sometimes used by funds to do interest rate hedging. We also see here the deployment of other mutual funds and ETFs in the portfolio, which is again not specifically mentioned in the investment strategy, but we have gathered from the bios of the fund managers. There is unfortunately no more data available from Fidelity, so let's try to get some additional information from Morningstar. For the equities component, Morningstar shows the fund is currently holding mainly large cap stocks with no bias towards value or growth style. There is a high overweight in financials and industrials, but I'm wondering if the financials allocation is distorted by the derivatives exposures. Financial ratios look quite in line with average, so we can't deduce much from there. Dividend yield is at 2.79%. For the bonds component, Morningstar shows there is around 23% sovereigns, 20% corporates, 7% securitized, and 11% cash equivalents. There is a large chunk of 39% others, which we have no idea what it includes. Maturity breakdown shows the portfolio spreading it quite widely across the different tenors. We can also see the yield to maturity is 6.19% and weighted coupon is 6.33%. Now, with all the information we have so far, let's do a little calculation. The investment strategy states the income of the fund is mainly derived from equity dividends and bond coupons. We established that the portfolio allocation over time should hover around 33% equities and 66% bonds. Morningstar tells us the current portfolio has around 2.8% equity dividend yield and around 6.3% bond coupon yield. So this means the natural income that is available to be paid out as distributions by the fund should be around 5.1%. Let's see later if this gels with the distribution policy of the fund. For a retail investor-focused product, Fidelity GMAI comes in a variety of share classes to choose from. The usual share class offered to retail investors is the A share class. Besides the base currency US dollars, the fund also offers Sing dollars, Aussie dollars, Euro, Sterling pound, Hong Kong dollars, and Japanese yen currency classes. The fund offers accumulation class in US dollars. However, most of the other currency classes only have distributing share classes. The fund initially launched the US dollars accumulation and monthly distributing share classes, as well as Sing dollars quarterly distributing share class in 2013 at fund inception. I don't know why Fidelity opted for a quarterly distributing share class to start. But they quickly launched a monthly distributing Sing dollar class in 2014, followed by a Sing dollar hedge class in 2016. Thereafter, in 2018, the fund launched a US dollar class and Sing dollar hedge class with a different distribution policy that I will talk about shortly. The fund charges 1.25% management fees for the A share classes. Adding other expenses comes to a total expense ratio or TER of around 1.74%. This is broadly similar to other global multi-asset funds in the market. Up to 66% of the management fees can be paid by Fidelity to distributors as trailer fees. Distributors can charge up to 5.25% subscription fee, although I think anything more than 2% for mutual funds is excessive. Now let's go through the share class terminologies for distribution. The bracket G in all the share classes refer to gross income. This means the TER will be deducted from the NAV and not impact the distributions. The earlier created distribution classes are all income classes. These classes aim to provide a stable or smoother distribution payout over time, so the distribution amount normally stays the same for several months before getting reviewed and adjusted. It is stated the share class may use some capital as necessary to maintain the stable distribution. The newer created distribution classes are CDIST classes. The C refers to higher distribution rate than income class, and the distribution amounts are not stable or smoothed. It is likely capital will be used to make up for the higher distribution yield. DIST is just used to refer to normal distribution classes. Given distribution history is available in the fund webpage, here is a quick compare of the M income share class versus MCDIST share class to show smoothened versus non-smoothened payout. Don't compare the absolute distribution dollar values because it is the percentage that is more important. The share class distribution yields, however, is difficult to find and doesn't seem to be available in Fidelity's website or fund documents. As such, I have obtained the 12-month yield from Morningstar instead. Here, we can see the M income share classes are having a distribution yield of around 6%. This includes the Sing Dollar hedge share class, which means the currency hedging cost is also factored into the NAV as well. The MCDIST share classes, on the other hand, are having a higher distribution yield of around 7.6%. As mentioned earlier, these were created to provide higher distribution yield choices compared to the M income share classes. Remember earlier we calculated the natural income that the portfolio currently generates is around 5.1%? This means that if the fund maintains the current levels of distribution yields, the M income classes will have to take around 0.9% from capital to top up to the distribution payouts, while the MCDIST classes will have to take around 2.5% from capital to do the same. Now, as investors, you need to bear in mind that distributions are not free money. Every bit taken from capital means there is less capital remaining for future growth. So higher distributions is not necessarily a good thing. Furthermore, we will need to see if the fund can actually generate enough returns to cover the distributions. Otherwise, we will be seeing a declining NAV over time. Fidelity provides a nice dynamic performance chart on its fund web pages that allows for flexible entry on the start and end dates, up to the last day of prior month. There is, however, no benchmark for the fund, so we can't really tell if this is a good or bad performance. You can also ignore the second line that factors in a 5% subscription fee, because if your bank charges you 5% subscription fees for mutual funds, you should immediately change your bank. Besides performance chart, the fund webpage and fact sheet also provides cumulative and annualized returns data across various time periods. There is, however, no calendar returns data. What is quite clear from the annualized returns data though is that the returns across all time periods are significantly lower than the 6% distribution yield for M income classes and the 7.6% distribution yield for MCDIST classes. As such, the fund NAV must have declined over time. Fidelity doesn't hide this, as the same dynamic chart can be used to display NAV movement as well. Here is the AM Income G US dollar class, where it shows the share class originally was trying to hold NAV in the $9 to $10 range since inception. There was a permanent NAV loss during the 2022 sharp interest rate hike period, and now the share class is trying to hold NAV in the $7 to $8 range instead. Now it appears the M income class at least is trying to hold the NAV within the range. There seems to be hardly any effort to recover the NAV back to prior highs, so it looks like the share class is paying out pretty much whatever it generates in returns. The AMCDIST G US dollar class has gone through a similar NAV movement, currently holding the NAV also in the $7 to $8 range. Given it was incepted in end 2018, the original NAV range was a little higher at $9.50 to $10.50 range. The other share classes pretty much have a similar graph, with small differences here and there. Let's use Morningstar to do some comparisons. For a start, here are the US dollars, Sing dollars unhedged, and Sing dollars hedged share classes to show the performance differences. The Sing dollar hedge class shows a persistent lag against the US dollar class, as there is around a 1% to 1.5% per annum currency hedging cost that trims down the returns. The US dollar unhedged class shows more volatility, and it sometimes outperforms the US dollar class, but always for short-term basis. Sing dollar investors will need to consider whether to go with the hedged or unhedged share class, depending on your preference for the performance experience. Let's look at peer comparison next. These were the more popular global multi-asset income funds in the retail market before several more fund providers joined in the party in recent years. Looking at the long-term performance here of about 12 years, JP Morgan Global Income has stayed comfortably in leader position, while Fidelity GMAI seems to have lost second place to BlackRock GMAI since the market correction in 2022. Schroder GMAI used to be the weakest in performance but appears to be catching up in past 3 years. Looking at nearer term with a 3-year chart, it is very clear that Fidelity has significantly underperformed compared to the other 3 peers that appeared to have quite similar performances. It should be noted that the broad asset allocation constructs are slightly different among the funds. JP Morgan has about 50 equities, 50 bonds, BlackRock has about 40 equities, 60 bonds, and Schroders has about 30 equities, 70 bonds. JP Morgan and BlackRock similarly do not have a defined benchmark, but at least their performance are better, right? The consolation is that on 1-year basis, Fidelity GMAI appears to be performing on par with the rest of the peers. But on par is not good enough to compensate for the prior years of weaker returns, so Fidelity does need to urgently improve its performance. One main reason I don't really like all these multi-asset income funds is because I feel they are an overcomplicated strategy that don't deliver enough returns. Let me throw in 2 examples here. If you are considering these funds for income needs, the most obvious alternative is to go with a pure bond fund that generates similar distributions. I'm using PIMCO GIS Income here, not saying it's the best bond fund out there, but simply because it is the most popular in the market. We can, in this 10-year chart, see that PIMCO GIS Income is easily comparable with BlackRock GMAI, and only JP Morgan Global Income has performed better. To make it even simpler, considering you are taking equity risk and plenty of high-yield bond risk in these multi-asset income strategies, you can easily replace with a pure US high-yield ETF, such as the one from iShares as an example here. As seen, the iShares US high-yield ETF has a very similar performance line and has outperformed all 4 multi-asset income funds in the past 10 years. Tweaking the time period shorter doesn't make much of a difference, as seen in the 3-year chart here. So what this really tells us is that these multi-asset income strategies are overrated. They are not generating enough returns to compensate for the equity risk taken, and there don't seem to be much of diversification benefits. With that, let's summarize our findings. Fidelity International is the international business entity of Fidelity, one of the largest asset managers globally. One big issue I have with this fund is that there is absolutely no details on the actual investment process, so investors have no idea how the fund actually works. Fidelity seems to handle this fund like a discretionary solution in terms of investors' communications. Additionally, the fund has no defined benchmark or returns target. There is no easy way for investors to assess whether the fund is doing good or bad. The distribution share classes of the fund appear to be paying out all the gains plus a bit of capital. The consolation is that at least the yields are not set excessively high and the fund NAV can still maintain in the range over time, with the exception of the permanent loss during 2022 market correction. Performance over time is clearly weaker than other popular peers in the market. The fund will need to improve its returns to be competitive enough. As earlier explained via performance comparisons, the broad multi-asset income concept is overrated. These strategies are not generating enough returns to compensate for the equity risk taken, and there don't seem to be much of diversification benefits. They can be easily replaced with a good bond fund or a high-yield ETF for similar risk-return expectations and distribution yields. In conclusion, there really isn't much positive aspects I can think of with this fund. I have no idea what is going on in the fund with the lack of investment process information. The relative poor performance shows the fund strategy has not been successful, and the multi-asset income category is by itself an overrated strategy. So this fund is really quite unappealing in my view. This concludes my absolutely biased comments on the Fidelity Global Multi-Asset Income Fund. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.